What's next for the volatility cycle? I got a chart on that in a little bit. Let's move to the first slide. It seems as though good news continues to be bad news for stocks, except for inflation reports like we got today. Earlier in the week, as I understand, we had two big down days over 1%. It was the 58th and 59th moves over 1%. That's more than it was in 2008. And I think on Monday it was like the PMI or some shit like that. I don't know. I actually don't pay attention to PMI. I'm with you guys there with regard to those reports. I know they're important for a lot of different reasons. I don't really care about them. But the market seemed like it took it as a reason to drop, particularly on Monday. And then we had those 5 days in a row we were down. So a little surprising. We went back below what we saw prior to Powell's speech on 11:30. It's only the second positive week for the dollar in the past 8. Dollar's definitely been on the downtrend as markets started to bounce back. But now, even though we've dropped, it doesn't seem like the dollar has risen a whole lot. Again, we're positive on the week, but not by a huge amount. 10 and 30-year bonds. Oh, you had something to say? My bad.
No, I was just going to say I wouldn't buy the dollar here. I don't care what happens. I wouldn't touch the dollar for a year.
I would agree with that. I mean, I probably feel like it's a bigger. I've been saying this for a couple of weeks. I just feel like it's a bigger sale here than it was 3 months ago. When it was
100%.
10 and 30-year bonds are at 3-month lows. That belly of the curve has been beat up more recently, and all durations are lower since Powell's speech on 11:30. What are you guys looking at in bonds these days? What are you doing?
We've been surprised by we were bullish on bonds, but we're surprised that it got so far so fast.
Yeah,
we were a little surprised by the size of this move.
Mm-hmm. I think TLT is up 15% in the month. I was a little surprised by that. I didn't realize that.
Yeah, I got whipped on both sides. I mean, I think I got the 105 or 4 straddle on in there. I watched it go down to low 90s and now 108. I mean, it's just crazy. 109.
Do you think we're going to get some crazy moves in bonds in the next 6 months, or is this kind of just a no?
No, I think they're done. I like the yield curve. I mean, I loved bonds when they got down towards 120. At 130, I have no directional bent here at all, but I do like the yield curve trade for next year.
Gotcha. Yeah. Okay. Seems like there was a lot of China news. China rapidly seems like they're giving up on the policies that pushed down COVID. We've seen a lot of the names rise recently. Tom, I know about a month or so, maybe almost 2 months now ago, you were really loving the China trade. How are you feeling about that now?
No, I haven't touched. I have the same position on. I'm basically long China, but I'm a lot less long. Yeah. Like when Baba was $65, I was really long it. When it's 90 here, I'm pretty flat.
Gotcha. Okay. And while VIX is above 22, it remains dramatically low relative to realized volatility. I'll show you what I mean in a little bit. Let's pull up some slides. Let's move ahead, John, please. First one, volatility cycle, right? So you got the median and the bars. We got the average. The average is usually easier to look at when you're talking about statistical movements. In general, we do see volatility trend down in the summer and trend down heading into December. It's been a weird year, just to give you an idea of but this is to give you an idea of what we normally see. Again, with the beginning of this month, we haven't really seen that. We've seen volatility tick up, but it was really low coming out of the end of November, with the huge move that we had after Powell's speech, and volatility came basically below 19. But now it's perked up a little bit. We'll see what the rest of the year holds, but we all know it's been a very unusual year. So hopefully it doesn't throw us off too much. But you guys agree with this, right? In general, volatility, in most years. So we'll see what the new year holds. Let's move ahead to the next slide. This is kind of what I was talking about. We've looked at this plenty of times before. This is basically the look at expected volatility in the terms of VIX minus where volatility has come from in historical vol. It's pretty common measure. Volatility people love to look at. Volatility risk premium is what it's called. Right now, historical vol is a bit above the VIX right now. Now, they're both relatively low, but historical vol is a bit above. We've been moving quite a bit. You can see the difference that I've made here between June and between now. June, of course, volatility was high. I'm pretty sure we were probably close to the 30s. but historical vol was that much higher because we had been moving so much. Now, historical vol is higher than VIX, but they're both fairly low. But again, just showing you the idea of how much higher historical vol is versus the VIX right now. So keep that in mind. What we really like to do, right, is get short at the times where this thing is sitting around 5 or 10, where VIX is that much higher. Mm-hmm. That coincides with what we talk about when we have that chart, which many of you have seen, it's a famous chart with how you should spread out your buying power based on where VIX is trading. So to give you an idea right now, I wouldn't say there's not in fantastic opportunities overall. That's all this is kind of letting you know. Fair. Let's move ahead to the next. We talked about this before, but it's interesting. Now we got oil lower on the year. And I'm pretty sure one of the three of us was screaming for oil to be much lower going back to June. Said it needed to be lower. You were right, my man. And got to give you props. Oil is negative on the year right now. But again, like we say, doesn't mean the stock names are down. And this is something I always notice. A lot of times, you have oil names that act like oil names, and then every now and again they act like stocks. Same deal with like gold stuff every now and again. So yeah, XLE is trading that much higher than actual crude oil right now. This is a chart that's going around everywhere. I just saw it even again this morning.
We noticed this a while ago. I can't imagine that something's got to give, and it's got to be the equities, not the underlying commodity.
I think so too, and that's exactly right. Tom is pointing out the idea when you see a chart and you see this much separation, things that are supposed to be kind of similar, something's going to change at some point, and it'll come back in line.
To normalize, yes, agreed.
Mm-hmm. Let's move ahead. Boy, oh boy, it's been a year for crypto, huh?
Who would have
These are just a few of the things. Say what?
Who would have thunk?
Who would have thunk? February, of course, Russia and Ukraine, and the first rate hike. Those weren't specific to crypto, obviously, although the rate hikes were intended to push asset prices down, especially crypto. But then you had stablecoin and Terra USD peg collapse. Then you had Celsius freeze withdrawals. Then you had Three Arrows Capital ordered to liquidate, basically because of Voyager had to declare bankruptcy because of the loan they tried to give Three Arrows. Not smart by them. Then you had, of course, FTX, which ever since then, it seems like every time there's a little news point, we get a drop in Bitcoin. As you can see, prior to that, Bitcoin was kind of flatlining around 20K, plus or minus 1% to 3%, right? For a while there, it was just kind of sitting there. We knew it was going to make a move in either direction. There was all this talk about how low volatility was in Bitcoin. And then boom, FTX happened. And then now we got a new lower level. And it seems to be 16K, to be honest with you. We seem to be somewhere around 1% to 3% around 16K. So it is what it is.
It is what it is.
Yeah. I don't all things considered, I think it's hung in there pretty well. I just think the sad part about what FTX did is they just killed all the enthusiasm for the space. That's all.
Yeah.
But it seems to be stabilizing, right? I mean, I think that's the interesting thing for us. We've seen a few things here and there, and obviously fear dominates for a while, but then after the fear kind of goes away, people kind of look around, but it's not that bad. It's what happens. It's what happens. Let's move ahead to the next slide. Used car prices have collapsed 14% year over year. That's the most on record. And the biggest poster child right now apparently is Carvana. It looks like they're near bankruptcy. Not only does the stock look sick, the bonds aren't good neither from what I hear. So, but it just goes to show you how crazy things got. And by the way, I feel like, and from what I understand, used car prices are still like 58% higher than they were prior to the pandemic. So there's still something there, but yeah, this has been an interesting space to watch overall.
So, Tom, if I could for a quick second, because I've got a bunch of emails on this subject of Carvana going under and loans to Carvana and the billions of dollars. Is there any parallel or similarity to the housing market? Same kind of when we collapsed. Is there any type of parallel to those, do you think?
No.
Why?
Because
like in 08, you know what I mean?
Yeah, I know what you're saying. Because the housing market was collateralized the credit default swaps were collateralized with they were over levered, and they were collateralized with an inflated marketplace. Carvana was just was a real company that just got ahead of itself, and
So the leverage aspect isn't there. I mean, the leverage.
I don't think so at all. I
don't think
the challenge for companies like Carvana are very different. The challenge was, oh my God, we have built something amazing. So you basically, you're sitting on, let's just say, just as an example, you're sitting on a $1 billion company, and the $1 billion company, all of a sudden, for whatever reason, it's beyond your control, is trading at, 25 billion. And you're sitting there looking like, what are we going to do? Like we know we're not worth 25 billion. So let's borrow, 3 billion. Let's just start building it up so we can achieve what our valuation is trading for. Otherwise we're dead. And I think they just got caught up in their own press clippings. And it's kind of a story where, I don't think it's not a question of fraud. It's just a question of, hey, the stock got ahead of the company. And when that happens, it is very hard for these companies to, think of GoPro and think of a lot of companies like that. They actually built real products, but their stock got ahead of the products. Think of Beyond Meat. Companies have a really hard time when your stock gets ahead of you and then you try to play catch up to your stock price. It's horrible. That's all I can think of. I don't think it's anything else.
Sorry to interrupt you, Jamal.
No, that's a great interruption, and it actually makes sense. Yeah, I think you're right. I don't believe there's any leverage situation there with Carvana. It's just fascinating. Yeah, got ahead of them. Continuing claims, they rose to the highest level in 9 months. Basically saying that while people have been able to leave their job in the last year, people have been able to leave jobs and move to the next. This time around, people have not been able to find that next job. So again, you're talking about the labor market. That's the next shoe to drop. FTC is seeking to block that Microsoft and Activision deal. So Activision might become tradable again. We'll see what ends up happening. I usually stay away from deals, even in these situations, but just be aware of it. If you have a position on or something like that.
You got to stay away from this.
Yeah. I mean, you don't know more than these people do in this deal, period in the story.
And if you think you see something that's out of line, it's not.
No. CPI is coming up next week. So those are the main things next week. They're coming at you hard and fast. CPI, FOMC, and then triple witching expiration. And we're basically just right off into the sunset after that. Finally, market measure, where velocity of risk comes from. Basically looking at skew and how things move, different assets move, downside or upside. Take a look at that. Very interesting. That's all I got, fellas.
Very good. Very good.
Awesome. Thanks, Jamal.
Let's take a quick 90-second break. We'll catch the opening bell here coming in about 4.5 minutes. Let's Taste Trade Live.